Microsoft jumped on the Gen AI bandwagon early.
Microsoft is reportedly in talks to invest $10 billion in OpenAI.
Microsoft, yes, the largest company on earth, thanks to the company's early aggressive bets on OpenAI.
I hope that with our innovation, they will definitely want to come out and show that they can dance, and I want people to know that we made them dance.
But now, Microsoft looks like the mark at a poker table. Billions of dollars in CapEx, a premium valuation, little AI sales to show for it. And shelling out $13 billion for what Apple was able to secure for free just 18 months later.
Apple just announcing that ChatGPT from OpenAI will be integrated into iPhone, iPad, and Mac software.
Microsoft could be a warning to the broader AI space, as experts increasingly warn of a widening gap between what companies are spending on AI and what they're getting back from it. I'm Deirdre Bosa, and this week on Tech Check, AI's trillion-dollar time bomb. Generative AI promised to change everything.
Generative AI is going to reset the internet as we know it, and yes, it will change your life.
Better productivity, medical breakthroughs, environmental sustainability, personalized learning.
And of course, we are only just getting started.
But instead, we got deepfakes, disinformation, spam, and plagiarism.
This is not Tom Cruise.
From robocalls to deepfakes, artificial intelligence is already playing a role in the 2024 election.
This AI will flunk you out of college.
In the past few weeks, 3 prestigious firms have sounded the alarm, detailing a growing problem within the nascent AI space.
There's a big report out Friday from Goldman Sachs in which they make the point that the amount of capital investment in this sector, which is billions of dollars now, it's so large that it's almost unimaginable that we're going to get a rate of return on it over the next few years.
Spending is too high and returns too low. To Sequoia, this is a mere $600 billion crisis. To Goldman Sachs, it's a $1 trillion problem. And one analyst at Barclays dubbed it the gazillion-dollar question. But all are pointing to the same issue. Big tech firms like Microsoft, Alphabet, Meta, they have thrown mountains of cash to build out the infrastructure to stay ahead of the AI game. Things like high-end computer chips or GPUs, data centers, and power supply. In the latest quarter, Microsoft's capital expenditures, or CapEx, surged 79% to a record $14 billion and said it'll continue to grow. Google's shot up 91% to $12 billion. Meta's came in at $7 billion and expects the spending to swell to up to $40 billion. Amazon reported $14 billion in CapEx for Q1, and CFO Brian Olsowski, he told analysts that he expects that to be the low quarter of the year. Its cloud unit outright bought a nuclear-powered data center in Pennsylvania for some $650 million this year. According to experts, the problem here is that the spending is far outpacing the revenues that these companies can actually expect to see as a result of AI.
The amount of capital investment in this sector, which is billions of dollars now, it's so large that it's almost unimaginable that we're going to get a rate of return on it over the next few years.
For one, they say there has yet to be any killer applications of AI, use cases that actually makes workers ultra productive or efficient.
To sit there and make the argument that if you gather all the world's data, you process it all into one giant training set, and then from that, you use generative AI in your LLM to produce the answers people are looking for. That hypothesis, I think we can safely say today, is at best flawed. It may be complete baloney.
Goldman Sachs' Jim Cavello puts it this way. AI bulls seem to just trust that use cases will proliferate as the technology evolves. But 18 months after the introduction of generative AI to the world, not one truly transformative, let alone cost-effective application has been found. Sequoia, the venture capital firm that made early bets on Apple, YouTube, and Instagram, asks, outside of ChatGPT, how many AI products are consumers really using today? The term for this kind of enthusiasm on Wall Street, irrational exuberance, unfounded market optimism without a basis in fundamental economic realities. One of the experts raising a red flag is an MIT professor who says the promises of a huge productivity boost are way overblown.
Those estimates are quite exaggerated because if you look at what the current models are capable of doing, The most reasonable thing to expect is that within the next 10 years, they're going to do a little bit more of the same.
He forecasts that AI will increase productivity by just 0.5% and GDP growth by less than 1% in the next decade. Another Goldman analyst says his main concern is that AI technology is exceptionally expensive, and to justify those costs, the technology has to be able to solve complex problems, which it isn't designed to do. Barclays simply says the math doesn't add up. Wall Street expects $60 billion of incremental capex spend, with just $20 billion, 1/3 of that, to show for it in extra cloud revenue. And Sequoia has also crunched some numbers, seeing, quote, a big gap between the revenue expectations implied by the AI infrastructure build-out and actual revenue growth in the AI ecosystem, a gap that is now $600 billion wide. But no one is comparing AI to the crypto or the SPAC bubbles of recent years. Bulls on the other side, they argue that there is real technology and real benefits. They may just take a long time for their effects to be felt.
It will take longer than most people anticipate, and that's very likely. Sometimes things just takes time and nobody has a crystal ball when it will happen. Then it might create some disappointment, and we saw that with the dot-com boom and bust, that all the promises of mid-90s did come to fruition, but it just took longer than people thought.
So despite concerns and constraints now, many, including Goldman Sachs, Sequoia, and Barclays themselves, they continue to be optimistic about the long-term effects. Research from Gartner says there's a pattern of adoption, what they call the hype cycle. First, there's an innovation trigger. In Gen AI's case, that would be ChatGPT.
The ChatGPT phenomenon. Everyone's been talking about the ChatGPT.
Then there's a peak in inflated expectations. That's where we've been over the last couple of years. The proliferation of chatbots, AI productivity tools, hundreds of mentions of AI on earnings calls.
AI is what everyone is talking about in boardrooms and in living rooms.
But ultimately, little revenue and monetization, and thus the growing recognition of the limitations and challenges associated with artificial intelligence, which puts the current view of AI in Gartner's third phase, the trough of disillusionment.
We have to be realistic about what it is that it can do. I think there's the jury's still out. I am completely convinced that there are some impressive changes and there are some things that AI can really help us with, but it's not going to suddenly revolutionize everything we do.
Gartner explains that is when experiments and implementations fail to deliver. Producers of the technology shake out or simply fail.
We're making assumptions about what this technology can do that we haven't proven yet. And as a consequence, we're applying it in places where it may not work. And if that's true, then the mania is going to come to an end, and the largest stocks in the S&P 500 are all going to be very heavily affected. And I just think every investor needs to take a moment and ask themselves how much longer they want to be on this ride, and whether there is any evidence that the products are actually going to deliver value at a large enough scale to justify the investment we've already made, much less the investment that we're planning over the next year or two.
The next phase, though, if and when it comes to fruition, could be lucrative. The slope of enlightenment. That is when the technology starts to crystallize and become more widely understood. Second and third generation products, they emerge and actually start to increase productivity and deliver results in a more meaningful way. And that's what the bulls are arguing. They say that even though using AI is expensive right now, more expensive than it's worth, those costs will come down, as with tech cycles before it. Others say there are signs of rational exuberance. Some investors are being level-headed, not backing .com one-offs like in the 90s, but instead putting money into profitable companies that have wide distribution and can actually tie their AI spending back to revenue.
The big significant capex is driven by hyperscaler. And all these hyperscalers are very profitable businesses. I think people are misunderstanding that, hey, these businesses are burning cash. They are not. They are actually generating cash from their business, and they're plowing back that cash in the businesses.
Finally, Gartner ends with the plateau of productivity. The technology becomes mainstream, and companies can clearly define how AI is bringing in money, but not again reaching those heights. Something AI still can't do: predict the future, and if or when real returns will ever justify the cost of AI.